Good afternoon. It's Thursday, January 10th. I'm George Corrali, and this is the Market Minute, helping you to become a better investor. The seasonal strength we usually see beginning in November failed to materialize, and the market got walloped into the end of the year. The S&P 500 declined about 20% from its September 21st all-time high. December was particularly brutal, recording its worst decline in history. So what caused all this investor angst? With the Fed signaling a continued aggressive schedule of interest rate hikes, slowing global economic growth, and the unresolved tariff situation between the U.S. and China, investors became spooked and headed for the exits. Was this just a big correction or the start of a major bear market? Technically, a decline of 20%, which we just experienced, is considered a bear market. The question is whether this is going to be a short bear market or more of a drawn-out one. Two short bear markets that come to mind are 1987 and 1998. We had a stock market crash in the fall of 1987, and in 1998 we had the Asian currency crisis, when several so-called brilliant PhDs from a firm known as Long-Term Capital Management almost brought down the world's financial system. These events caused the stock market to decline quickly, but both bear markets were relatively short-lived. So where do we go from here? We would play the market going forward as if this bear market had more to go. There will be opportunities, but investors will need to be more nimble. A bear market is tricky. It has a way of grabbing more money from investors' wallets as it progresses. People start believing that the worst is over and commit more money at exactly the wrong time, at the top of explosive mini rallies within the downtrend, right before the bottom drops out. The 2000-2002 bear market included three separate advances in excess of 20% from intraday low to intraday high, with many more advances in the 5 to 10% range before the final low was made. The 2008 bear market had many of these same characteristics. Huge rallies in the indices like the one we saw this past Friday when the Dow Jones Industrial Average rose by over 750 points usually occur within a bear market. Bottom line, we don't view the current market environment as a long-term buying opportunity or final bottom just yet. But when markets become so oversold as they have through December, conditions allow for an explosive rally. Any of these explosive rallies should be sold. A good general theme for more active investors would be to buy into deeply oversold conditions and sell after explosive mini rallies. The biggest mistake an investor can make right now would be to panic. Panic is not a strategy. It's important to keep perspective during stock market downturns. You should focus on the big picture. And if you don't have a plan in place, now may be a good time to sit down with an advisor to discuss an appropriate strategy. We're monitoring market conditions in your portfolios closely, and we'll be sure to update you if and when needed. Thanks for tuning in to the Market Minute. I'm George Corrali. We'll see you back here soon.